Welcome to the Halftime Report with DMI Wealth Management and Insurance Solutions. Today we're going to focus on reviewing the first half, taking a look at the potential market forces in the second half, then we're going to ask the question of where are we now, and finally take a look at what's ahead for the second half of 2023.
Here's a snapshot of the S&P 500 index performance from January 1st, 2023 through June 2023. The S&P 500 managed to post a gain helped by evidence of slowing inflation and the prospect of an end to the Fed's rate hike cycle. The communication services, consumer discretionary, and technology sectors were among the top performers in the first 5 months. The first half was dominated by three overriding themes: inflation, rate hikes, and recession fears. As inflation continued to moderate and the Fed signaled that rate hikes may be nearing an end, fears of a potential recession became the dominant investor concern. In addition to these macroeconomic worries, the markets grappled with regional bank stresses in March that periodically resurfaced in the months that followed, as well as having to cope with the uncertainty generated by federal debt ceiling negotiations. So we've talked a bit about how the S&P 500 performed so far this year, but how does that performance compare to expectations? At the end of each year, various media outlets compile some Wall Street analysts' predictions for the year ahead. This image shows several projections shared at the end of 2022. How do those predictions compare to reality so far? Well, the S&P 500 closed at the end of June at 4450. The S&P 500 closed at 3840 on December 31st of last year, so year-to-date stock market gains have been solid. This is far better than most experts have predicted, with 2023 full-year forecast for 2023 very muted, coming off a down 2022. Even the most optimistic forecast in this table represents a less than 5% increase for the year. The outlook was reflective of expectations that the economy could potentially fall into recession, while interest rates would likely continue to go higher. Predicting where the S&P 500 will be by the end of the year is always challenging, especially in 2023, given the uncertainties of inflation, global economic growth, and rising interest rates.
To create some context about where the economy may go in the second half of the year, let's start by examining where we stood January 2022. We picked this month as a reference point since it represents a moment in which the pandemic was now mostly in the rearview mirror. As the indicators suggest, the outlook for the coming 3 to 6 months was exceptionally optimistic. The Federal Reserve monetary policy remained accommodative, and the interest rates had not yet begun to climb from their historical lows. On virtually every important economic indicator, from inflation and monetary policy to credit demand and availability to energy costs, it was flashing positive. Only 3 indicators were neutral or cautionary: the political environment, equity market valuation, and geopolitical risk. There were no negative indicators. However, these conditions soon would reverse. Now let's jump to January 2023. In a short span of just 12 months, the economic outlook has done an about-face. We went from a set of speedometers that were nearly all positive to an outlook that contains no positive economic or financial indicators. After almost a full year of sharp and successive interest rate hikes by the Fed, there are now 7 indicators flashing red, most notably monetary policy, interest rates, housing, and leading economic indicators. The rest of the indicators are neutral. This is a good illustration, I think, of the impact across the economy and in the financial markets of going from near zero interest rates to about 5% in roughly a year's time. And things don't look any better 6 months later.
In fact, you could say that the outlook has deteriorated slightly. Today, we sit with 7 red or negative indicators, the same number as January. Perhaps the most notable change is that credit demand availability has moved into the red. This is a direct consequence of the regional banking troubles we saw flare up in mid-March with the collapse of 2 mid-sized banks. This banking stress has led many institutions to a more conservative approach to lending money by reducing loans that shore up the strength of their balance sheets. This may have significant economic implications since consumer and business borrowing are a major driver of economic activity. Fewer loans, in other words, may mean slower economic growth. To that point, let's examine what leading economic indicators are telling us. This chart shows a relationship between changes in S&P 500 performance and the 12-month forward earnings per share, or EPS. As you can see, the 2 lines have generally moved in the same direction over the past decade. However, as we can see, stock prices progressed ahead of earnings growth, which was then followed by a retreat in prices in 2022. Earnings have trended sideways for some time. However, more recently, stock prices have been trading in a limited range, possibly due to a lack of clarity surrounding corporate earnings.
At the highest level, the Federal Reserve has three functions: to provide effective payment systems for the U.S., to regulate banking operations, and to set monetary policy. When determining monetary policy, the Fed is tasked with supporting maximum employment, stable prices, and moderate long-term interest rates. As it works to uphold the monetary policy goal, one of the indicators monitored by the Fed is the overall level of consumer prices, which helps it determine whether to adjust interest rates. The Fed has stated that it's comfortable with the inflation rate in the 2% range. The charts we're looking at depict consumer price inflation on a year-over-year basis and a month-over-month basis. As you can see, the year-over-year inflation numbers are trending lower, though inflation remains above the Fed's target inflation rate of 2%, which is one reason why the Fed continued to raise interest rates during the first half of the year. When we look at the month-over-month chart, the numbers can be a bit more erratic. Expect the Fed's decision on monetary policy to continue to influence the financial markets through the second half of the year. Amid the challenging headwinds in the first half of the year, such as interest rate hikes, regional banking stresses, and a slowing economy, the labor market has been highly resilient. Despite all of the news of layoffs, a potential looming recession, and higher business costs, the U.S. labor market remains healthy. This labor vitality was an important support to the markets since having a job is foundational to consumer spending, which drives economic growth. This strength may be best illustrated by two labor market measures: the unemployment rate and current job openings. The unemployment rate continues to remain historically low levels thanks to robust hiring by private sector employers. Even in the face of its robust hiring, the percentage of companies unable to fill positions remains quite elevated. By these two historical measures, the labor market appears healthy.
The University of Michigan Consumer Sentiment Index is one of the most widely used sources to help analysts understand how the average consumer feels about the economy. This index is valuable as it surveys at least 500 residents of the U.S. each month by phone. The survey uncovers consumers' opinions regarding their own finances, as well as business conditions in the country. Understanding how people feel about the economy is essential because consumer spending accounts for more than 2/3 of the gross domestic product, or GDP. As the chart indicates, consumer confidence recovered from its historic lows in June 2022. More recently, those gains have eroded as recession fears and concerns over debt ceiling increase consumer pessimism over the near-term health of the economy. The financial markets were caught off guard by troubles at two regional banks in mid-March, leading to a sell-off that added to investor anxiety. And unresolved banking stresses may very well have been an overhang in the months ahead. The banking sector issues created two concerns for investors. One was that this was the first sign of economic issues as a result of the Fed's aggressive monetary policy, which triggered fears about something else having troubles. Regional banks play a vital role in the U.S. economy. One investment bank found that small and mid-sized banks account for roughly 50% of commercial and industrial lending, 60% of residential lending, and 45% of consumer lending. The second was a worry that banking issues would reduce lending to businesses and consumers, leading to slower economic growth. But as you can see in the chart, the March concerns have eased a bit. A value above 1 indicates that financial stress is above the long-run average, while a negative value signifies that financial stress is below the long-run average. As you can see, financial stress spiked in March following the bank collapses and improved in April.
Let's take a moment to consider the variables that may weigh heaviest on market performance. We believe the factors that led to the first half's market performance may remain critical to how the market may behave in the second half. The first factor is inflation. While accelerating inflation is no longer a concern of the market, some investors, and perhaps more importantly the Federal Reserve, worry that inflation may prove to be sticky at these elevated levels. If inflation remains where it is presently, then it may hamstring the Fed if it has any intention of pausing interest rates increases in the second half of the year. Sticky inflation will also very likely take any potential rate cuts off the table until inflation can resume its march lower, or if the Fed raises its 2% target to 3%, for example. Recession concerns have weighed on the market throughout the year, even as the economy has remained resilient. However, cracks are appearing in the economy. Manufacturing is weaker, the labor market is slowing, and leading economic indicators have been trending lower. Moreover, China, an important driver of global economic growth, has experienced a smaller than expected economic rebound. According to the consensus Wall Street estimates, corporate profits may actually increase in the second half of the year thanks in part to greater efficiencies, lower headcount, reducing capital spending, a weaker U.S. dollar, and a still strong consumer. Expectations are modest, but healthy earnings surprises may lift investors' sentiment and drive valuations higher. Of course, no one can predict what will happen in the future, but we hope the following perspectives help you understand what we believe may be on the horizon. Economic growth may be an integral variable in how the markets perform in the coming quarters. To get better insight on how economists think the economy will perform, we took a look at the May 2023 survey of professional forecasters conducted by the Federal Reserve of Philadelphia. We'll look specifically at the consensus forecast of three key economic factors that may drive much of the market's perception about the state of the economy. They are GDP growth, unemployment, and inflation. As you can see in the charts, the consensus view of the May 2023 is that the GDP growth is expected to be between 0 and 1.4% in 2024. Meanwhile, these professionals are projecting that the unemployment rate remains low at between 4% and 4.9% in 2024. And they expect inflation as measured by the core PCE, or personal consumption expenditures, to be between 2.5% and 2.9%. Now remember, forecasts are based on assumptions and subject to revisions over time. So we don't know exactly how these things are going to turn out, but the results that we're predicting may be different from what we experience.
Some market strategists look at the bottom-up earnings per share to help set their price target for the S&P 500 index. When setting a bottom-up EPS, market strategists focus their attention on estimated earnings for all S&P 500 companies. By contrast, a top-down investing target price places a greater emphasis on macroeconomic factors when making an investment forecast. This chart shows the bottom-up EPS and the price of the S&P 500. A word of caution that this type of analysis shouldn't be seen as a perfect predictor of stock price performance. In this chart, notice how stock prices have been trending flat to higher while corporate earnings are trending lower. When evaluating this chart, it's important to remember that the stock market is considered a discounting mechanism, which means that it is always looking forward. Put another way, the stock market's price today represents all available information about current and future events. How forward-looking is the stock market? Most would agree its discounting activity is 6 to 9 months into the future. So are stock prices seeing a turnaround in earnings? That's uncertain, and only time will tell. Considering the importance of corporate earnings to stock evaluations, the big question for investors is, what can we expect for future corporate earnings? In the previous image, it was clear that earnings have been trending lower during the first half of 2023. However, market analysts expect that earnings growth will improve in 2024. If you take a look at the chart, you'll notice that earnings growth projections have been cut for nearly every industry sector of the S&P 500. Near the center of this chart is the earnings growth projection for all the companies comprising the S&P 500, which is estimated to be 11.6%. Some sectors are expected to do better while others are projected to lag.
Future progress on inflation may be a bit more difficult. One aspect of inflation in particular, focused for the Fed as well as market and analysts and economists, is what we call sticky inflation. Sticky inflation refers to the components of the consumer price index that have historically exhibited a greater stickiness and rigidity with respect to price changes. In this chart, 12-month sticky inflation is the orange line, while the 12-month CPI is the gray line. Sticky inflation includes many service-based categories, including medical services, education, personal care services, as well as most of the housing categories. Fed Chair Jerome Powell has often referred to the stickiness in service-related inflation as one reason for remaining vigilant in the Fed's fight to lower inflation. And as you can see in the chart, despite progress on overall inflation, the Atlanta Fed's measure of sticky inflation has been stubborn. So needless to say, the Fed has much to consider as it evaluates monetary policy. Among the biggest questions investors have heading into the second half of the year are, will the Fed pause on rate hikes? Will the Fed cut rates by the end of the year, especially if the economy slows down? The next 3 meetings of the Federal Reserve Open Market Committee, or FOMC, are likely to answer these questions and provide additional clarity for investors. The FOMC is scheduled to meet 3 more times in 2023, in September, October, December. Typically, if the Fed is going to make an adjustment to interest rates, it will announce the change following their 2-day meetings.
Here's another relationship to understand. Bond prices and bond yields have an inverse relationship. In other words, when bond yields go up, bond prices go down. After experiencing years of low interest rates, some investors may be surprised to realize their bonds can lose money if sold before they reach maturity. Bond values may decline during periods of rising interest rates, but a changing tide in the economy doesn't mean you have to abandon fixed income. Often, this movement is an important part of a well-balanced, diversified portfolio that may provide investors with the income they need. Tuning out headline noise while managing your finances is not always easy. However, wise investing involves more than reacting to headlines that may discuss consumer sentiment or geopolitical developments. For investing opportunities, one approach is to stay focused on fundamentals, like a company's earnings or economic data.
We've gone over a lot today, but I'd like to conclude with a longer-term perspective on the financial markets. Having this perspective, I think, is key when pursuing the financial goals we've set for ourselves. After a disappointing 2022, frustrations may be high surrounding the progress of your investments. That's why this analysis of bull and bear markets during the period from May 1970 to October of 2022 is critical to review. Here we see that the average bull market lasts nearly 76 months. On the other hand, the average bear market has a little over 15 months run. As of May 2023, we were in a bear market that started in June of 2022. When stock prices dropped 20% from a recent high. Into early June, however, some were saying we entered a new bull market. So stay tuned. As we can see above, the rewards of a growing and innovative economy often go to investors with the discipline to remain invested over the long term. The next point I'd like to convey is a cautionary one on the temptation of getting caught up in the exciting new investment themes. This chart illustrates such exuberance happens from time to time. As you see, faddish themes have occurred fairly frequently since the 1970s when gold rallied higher only to trend lower. These trends can develop in a broad market, like Japan and Asia in the late 1980s and 1990s, or they can form in certain asset sectors, such as internet or biotech companies. Recently, artificial intelligence, or AI, has been receiving quite a bit of attention. What I want to emphasize is the importance of following a long-term investment strategy and not getting sidetracked by fads. Does AI offer the potential of a meaningful capital growth for investors in the years ahead? It may very well, but there are other ways to incorporate AI into an investment strategy that takes into consideration your goals, time horizon, and risk tolerance. So keep in mind that some of the investing fads you're looking at could be considered sectors of the stock market. And because of their narrow focus, a sector investing strategy tends to be more volatile than an investment strategy that is diversified across many sectors and companies. Sector investing is also subject to additional risks associated with its particular industry. And sector investing may be adversely affected by political, regulatory, market, or economic developments.
Thank you so much for your time today. For more information and timely updates, please follow us on social media and contact us at any time. We hope that you enjoy the details we shared with you today.